In this video, we're going to talk about the top 10 best stocks you should own for life. So before starting, please do like this video and subscribe to the channel for future updates. Investing for buy and hold is more difficult than it appears. Even the most successful dominant firms must constantly adapt to keeping up with the rising rate of technological development. In the future, industries such as energy, real estate, and even consumer products may face severe long-term changes. Amassing a retirement stock portfolio just by buying the best firms and holding them for years can be a dangerous venture in any period. Until it went bankrupt in the last decade, General Motors NYSE GM was a quintessential widows and orphans stock. United States Steel NYSE X has been a buy-and-hold company and a bedrock of corporate America. Eastman Kodak and Polaroid were previously blue-chip stocks. As cameras transitioned from film to digital, both companies went bankrupt. However, there are still equities to buy and hold that can survive indefinitely while still paying dividends. Here are 10 retirement stocks to buy and hold for the rest of your life. Number 10. Republic Services, RSG. Republic Services NYSE RSG is a smaller and less well-known competitor of Waste Management, NYSE WM. However, in this case, that isn't always a negative thing. Over the past 5 years, Republic Services has outpaced its larger competition in both revenue and earnings. Over the same time period, RSG stock has outperformed WM by a small margin. Republic Services is valued slightly higher than Waste Management, at least based on forward earnings multiples, indicating that investors expect that this will continue. RSG and WM are both good long-term investments. Both organizations should be able to survive for years to come because of contracted revenue and consistent demand. In a rather fragmented market, there is room for more acquisitions due to somewhat stronger growth and more room for margin improvement. Republic Services wins the round. Number 9. Fortune Brands, FBHS. Diversifying an investor's portfolio is typical advice. That is exactly what Fortune Brands Home and Security, NYSE FBHS, has done. Cabinets, plumbing, doors, and security are the company's 4 segments. Moen is a well-known plumbing brand, and Masterlock is a well-known security brand. FBHS is a more cyclical stock than the others on our list, and it has undoubtedly profited from the steady, albeit slow, housing recovery in the United States. However, the company's products create rather consistent replacement demand, and the dividend is a small but growing source of income. Fortune Brands have been a standout firm since its inception, and its stock has performed well since its IPO in 2011. There may be a little more volatility here, but for long-term investors, that's a small price to pay. Fortune Brands has enough value to weather any market jitters. Number 8. Lamb Weston, LW. Conagra Brands, CAG, spun out of Lamb Weston, LW, last year. In the United States, Lamb Weston is the leading potato producer. Indeed, among other restaurant chains, it produces the well-known fries at McDonald's, McD. While serving restaurants of all sizes, Lamb Weston also has a consumer business, including a small segment that manufactures frozen veggies. Health problems may appear to be a long-term challenge for the company, but growth has been consistent for years, and margins are improving. LW is focusing on overseas markets for expansion, as French fries have a considerably lower market penetration than Americanized items, and international audiences are generally interested by Americanized products. Despite its growth and market share leadership, LW stock appears to be much cheaper than it has been in a long time, trading at around 17 times next year's earnings. In the CAG split, the corporation took on a significant amount of debt. However, it is paying down that debt, which should cut interest costs and increase cash flow in the future. LW appears to have opportunity for growth, despite the fact that several similar firms are trading at significantly higher multiples. Furthermore, any health-related issues in the United States should be countered by overseas prosperity. The United States' love affair with French fries isn't going away anytime soon, which should ensure years of stability for Lamb Weston. Number 7, International Flavors and Fragrances, IFF. International Flavors and Fragrances is a firm that most people aren't familiar with, and many investors aren't aware of it either. The company develops flavors and fragrances for 13 different categories, including cosmetics, perfumes, beverages, and sweet flavors, as its name suggests. Sales and earnings have risen steadily, as has the stock price for IFF. With a PE of 20.75, IFF appears to be a touch overpriced. Investors should pay for quality, as they do with McCormick and the other stocks on this list. Because of IFF's underappreciated but critical position in so many industries, it is well protected from both competition and macro forces. Acquisitions and a burgeoning cosmetic additives company both offer opportunities for expansion. Consumers may be unfamiliar with IFF, but investors should be. Number 6, Allstate. All. The motto, "You're in good hands," has been used by the Allstate Corporation, NYSE-ALL, for a long time, and it's true for Allstate investors as well. From its late 2011 lows, all stock has nearly quadrupled, and there may be more good news to come. After all, with a PE of 7, Allstate isn't too pricey. All should resume its upward march once any short-term concerns have passed. Number 5, McCormick Company, MKC. McCormick Company is another solid company with a price tag that may alarm some investors. However, MKC stock is rarely available for a low price. The company's dominance in the spice and seasonings business provides a strong moat as well as security from economic downturns. MKC stock fell after the business agreed to buy French's Mustard and Frank's Red Hot Sauce from Reckitt Benckiser, OTC MKTS, RBGLY, for a price that many investors considered to be too excessive. MKC, on the other hand, has recouped all its losses and then some. McCormick's top-line growth will most likely be consistent rather than dramatic. The same can be said about MKC stock, which has returned an average of 13% per year, including dividends over the last decade. MKC should still be able to generate double-digit annual returns in the future thanks to ongoing cost-cutting initiatives, the contribution of acquired brands, and organic growth in organic products. Number 4, NextEra Energy, NEE. Utility stocks are one of the most popular buy-and-hold investments. By market capitalization, NextEra Energy, NYSE NEE, is presently the largest electric utility in the United States. That might be the only issue with the NEE shares. Given how difficult it's been for other energy companies, NextEra shares have rebounded rather well after plummeting in March. Aside from potential valuation difficulties, NextEra appears to be a winner. It caters to residents of southern Florida, which is still one of the country's fastest-growing regions. A PE multiple of 39 is high, but not outlandishly so for the space. Along the way, a dividend yield of approximately 2% generates income. Investors searching for a bargain in this area may prefer a smaller company like Dominion Energy, NYSED. However, quality is usually worth paying for, and NextEra Energy appears to be one of the greatest utility stocks available. Number 3, Medtronic, MDT. The healthcare market in the United States in particular appears to be volatile in this day and age. Increased spending concerns and political battles over the Affordable Care Act raise more questions than they answer. Medtronic, NYSE MDT, isn't going anywhere despite the uncertainties. Pacemakers, stents, bone grafts, and imaging systems are among the company's devices that are used in modern medicine. Even the sector's risks appear to be factored into MDT. Medtronic's days of double-digit annual growth may be numbered, but the company hasn't stopped raising earnings and dividends. MDT's stock isn't likely to stop rising. Number 2, Diageo, DEO. The alcohol industry is changing, with the number of breweries worldwide increasing, the new distilleries springing up. Diageo's NYSE DEO brands are well positioned to adapt to changing tastes. Diageo owns legendary brands like Johnnie Walker Whiskey, Tanqueray Gin, Smirnoff Vodka, and Harp and Guinness Beer, among many others. What most have in common is a timeless quality and widespread brand awareness. As a result, while beverage behemoths such as Coca-Cola NYSE KO and Anheuser-Busch InBev NYSE Bud have struggled to expand profits, Diageo increased operating profits by 5.8% in fiscal 2019 and intends to continue growing in the future. Diageo stock isn't overly expensive, with a trailing multiple of 22.1 and a dividend yield of more than 2%. Dio is a good long-term investment, and the dividends might be used to buy a bottle or two of premium whiskey. Number 1. Bank of America, BAC. It may appear odd to start the list with Bank of America. After all, it's only been a little over a decade since the financial catastrophe. During that crisis, Countrywide Financial, a BOFA purchase, blew up spectacularly after pioneering many of the risky strategies that led to the bubble and subsequent catastrophe. This is, however, a distinct BOFA. Last year, net consumer charge-offs reached a decade low. It has a good track record when it comes to credit metrics. Government rules have been attacked for delaying growth, but they have unquestionably reduced risk, even though some say that a better balance is required. Through his Berkshire Hathaway Incorporated, none other than Warren Buffett is now BOFA's top stakeholder. NYSE BRK.A, NYSE BRK.B. And the Oracle of Omaha likes to declare that his preferred holding time is forever. So, what'd you think about our video? Let us know in the comment box below, and please do like the video and subscribe to our channel for future updates.